We're both in multifamily real estate. We own about 3,000 units, give or take. He's been in about 7 years. I've been in about 3 or 4. What we're going to do, just how we always start off, is kind of just go around the room, give 30, 60 seconds, tell us your name, where you're from, any experience you have or something you want to learn, something about you and real estate. If you're a beginner, say I'm a beginner, looking to learn, that's perfect. So like I said, I'm Chris, work full-time with my family. I've been in about 3 years. I'm 27 years old. Currently live in Brooklyn, and we're focused on multifamily and mobile home parks. So I'm going to kick it off and just open it up for questions. Like I said, if at any time you have questions, whether you feel it's the best question in the world or the stupidest, please don't hesitate. We're more than happy to answer. Truthfully, you guys get more out of it when you ask us questions because we don't always know what's the best things to cover. Sometimes we talk too high level about stuff and we don't get into enough detail. So if I say something, you don't know what the term is, you don't know what I'm talking about, please stop me and just ask the question. We wanted to cover how to pick a market. We've done it in the past, but we wanted to bring it back because we had a lot of people come up to us, ask us stuff like that. And obviously, biggest part of real estate is location. So picking that location and where you want to focus and target is vitally important. So we wanted to cover it today really quick. A lot of this stuff we're going to be talking about, we are primarily out of state and out of the area. So we look a lot at like target cities and metros, but a lot of this stuff can be applied for neighborhoods and stuff too. So if you wanted to go buy a house in specific neighborhoods on Long Island or in the city, you can do the same exact thing and get it way more local than we tend to do and how we look at things. So if I do talk about picking different cities and stuff like that, you can definitely localize it more than we kind of do. So just cover the first one. A couple of the other things we're going to cover, right, is self-awareness. Biggest thing in real estate is kind of what your goals and motivations are, and it's going to change what you're looking for. Some of the things you should be looking for when you're looking at different markets and neighborhoods. A couple of the different factors you want to see: where they are, where they've been, where they're going, and just going to show how you can get a little bit more local as we kind of talk high level.
How many people here have the fear of investing out of state or in state? Why would that be a challenge for someone to invest out of state, and rather maybe they want to invest?
I think it's hard to manage.
Hard to control. Yeah.
Okay.
For me, if I want to move, I want to move out, but also get a property. So to move out, I'd have to pay rent. If I were to invest out of state, then I wouldn't be able to move out. So it's like,
Just to address that, I rent. I invest out of state.
yeah.
Shouldn't hold you back.
It's definitely harder to lay your eyes on it and do your due diligence, that's for sure.
I think financing is also, like I'm looking at out-of-state properties right now, and financing is also an issue because you have to...
Reasons we think having target markets is important. It's very easy to say I want to buy a deal in Long Island. If you're looking at single-family homes, there's thousands, probably hundreds of thousands. If you can start picking certain markets, neighborhoods, stuff like that, you can then narrow down your criteria and focus more and spend the time on stuff you actually want to buy, right? There's a very big difference between buying something in the Hamptons and buying something in Westbury, right? So knowing what kind of your goals are and then figuring out the markets you want to target, you're going to be able to focus better on the stuff you want to buy. Some of the other stuff, right, when you focus, you start to learn more and more about the immediate area, right? The better you know the area, you start learning the blocks, the streets, you start learning the areas of towns if you're looking at big cities. The more you start looking in those markets, the more you travel to it, the more you drive the streets, the better you're going to get to know those areas, the better decisions you're going to make. So if you're targeting all of Long Island, you're going to have less knowledge of Westbury than if you were just targeting Westbury. And the last one, just understanding the economics of the market, right? We flashed up before, population growth, unemployment, stuff like that. It's very hard to keep track of all that stuff. If you're looking at 50 cities across the U.S., it's much easier if you're only targeting 2 or 5 or 6. So just the more you can kind of come down, the better you're going to know some of that stuff.
Yeah, no, I agree. Everything you said is exactly what we do. And you can get focused. You can let a lot of that stuff pass you by. So if you really know what you're looking for in the economic side of it from the top down, you could throw markets out pretty easily if it doesn't check off certain economic indicators that you're going to want to see. And at the same time, Long Island's a big place. From Montauk to here, you're looking at 2 hours, an hour and a half traffic, whatever. Same thing goes outside of here. You want to know your market, but you also want to know the immediate part of the market. Just so a deal in Jacksonville, Florida is great. A deal on one side of Jacksonville could be completely different than a deal on the other side of Jacksonville. So understanding the immediate markets is super important. We'll touch on all of that as well.
Yeah. And just kind of coming back right to the goals a little bit that I was talking about, just to kind of expand on it as you see it up there, right? Just understanding what you want to get out of it, right? The distance is a big one. Understanding the market. On top of that, it's what type of investor are you going to be, right? Are you looking to build up a nest egg of cash quickly, or do you already have that nest egg where you're looking for more cash flow every year? That's going to drive where you're investing and what type of stuff you're going to invest in, right? If you don't have a lot of money, you might want to try to go into a high appreciation market like New York and wholesale or flips. That way you can bank on, buying something low and selling it high. If you've already got something, a ton of money stockpiled, more than you know what to do with, and you just want money coming in every month, right? You may want to look at something that's more stable with relatively predictable cash flow. So maybe a rental in, a core asset, in the middle of the city, downtown, something like that, where there's always going to be demand, stuff like that. So just kind of, again, knowing what you want to get out of it, knowing your own self, and knowing that it can change in the future, and it's all right to, pivot from one thing to the other.
Yeah, when we first started, the first property we bought was in Ohio. Yeah, we own one property in Ohio currently right now. It's a market we love, we just couldn't find what we were looking for. That led us to other areas. When we started, we got a little bit more, I would say, we wanted to be a little different than everybody else. We didn't just buy everything, the normal deal. We were looking for some significantly dilapidated, banged up stuff that we could come in and put some money into it. And that led us to different areas. We've taken some gambles on some more tertiary markets where, I wouldn't necessarily recommend it as a first-time investor to buy something in an area that's a little bit more remote. But, understanding the risks and what you're looking to accomplish and achieve is, critical in deciding where you want to be. If you want ease of commute, Mobile, Alabama might not be for you. If you're looking for something that you can get to in 2 hours, whether it's by car, airport, you're going to want a major metro, but that's going to come with a cost, whether it's a higher purchase price, a lower return, so on and so forth. So just understanding what you're looking to achieve and working backwards will make investing out of state, finding a market, it'll make all of that significantly more clear than just I want to make 25% a year. That's great, everybody does, but not understanding all that stuff is going to make that significantly harder.
I think some of it too it can be ancillary personal stuff, right? Especially if you're investing away from your area, whether it's an hour to drive or an hour to 3 hour flight, right? Is it an area you want to spend some time in, right? Like if you have a family, do you want to go down there for 3 days, spend a day checking in on your property, the other 2 days as a vacation, allows you to write off a lot of the expenses, which everybody loves, and then as well, it's an area you want to be in, right? So there's a very big difference between investing in Miami and Mobile, right? Where would you rather spend more time? I know my answer. So it's really other things like that maybe your return is slightly less, but you're going to have more enjoyment going to those areas. It might be the trade-off you're looking for. So it's not always necessarily a return basis thing too. There's other things to consider when you're making your decision. Some of the things we look for out there on the board: population growth, job diversification, unemployment, and crime. These you can all get as major or micro as you want, or macro, micro, but they're all hugely important, right? Population growth, you obviously want to see more people coming in than leaving, but there are places that people continue to invest, like New York, which are flat. So you got to decide how important that is for you. And in a minute, I'll show you all the different resources I have up there. Job growth, same thing, right? Are people go to where the jobs are. So if you've got jobs coming in, right? If your city or areas, pro-business, right? You're probably going to have people moving to the area. Job diversification is one a lot of people don't look at. It's looking at the different industries and what percentage it makes up of the total jobs. The reason we want to look at that, right, is look at places like Pittsburgh or Detroit, right? They were highly reliant on one industry. That industry left, and now it's taken them years, decades to recover, and they're not even where they were. So if you're heavily reliant on one industry, it's a little bit riskier and something you have to take into account. It's one of the things we talk about all the time, you know, with highly militarized towns, you know, a large military presence, you know, God forbid, you know, something ever happened where we deployed a lot of troops or they moved or something, right? A lot of your tenants are now gone, and it's going to be tough to recruit that. So it's, you know, same thing with college towns, right? Like colleges go out of business, right? Especially on the private side, you know, it happens. Look at Dowling, right? If you had student rentals for Dowling, you've now got to go out to the free market and find other people. So there's things that can be very stable, but you also got to realize that a large percentage of the business and economics around it are relying upon it. So you just got to risk and reward kind of that and make sure you understand it going into it. Unemployment, obviously huge. People don't have a job, they can't pay rent, especially if you're in rentals. If you're in flips or other things, maybe it's less important, but I still think it's a very important thing to know. And crime, obviously, is huge. Don't want anything happening near your property, but knowing what type of crime is going on, what the trend is, may make you more accepting of certain areas than others. And just, again, it's a risk-reward thing, right? You may be willing to take a little bit more crime if the reward's a little bit higher. So just balancing that out, again, aligning with your personal goals, right? If you say, I don't want to ever have to deal with crime, don't target that area. If you're okay and it's something you can work around, right, put less emphasis on it. So those are just kind of some of the things we look at when we're examining, you know, kind of major metros, as well as when we start hyper-focusing on neighborhoods and specific deals. I'm going to pull out some of that stuff, but if you want to talk about it.
So well, crime is a good one, because, you know, we have a property that we're actually going to contract tomorrow to sell. And we had a guy with an AR-15 literally probably about 2 weeks ago, just like on camera at the property, literally just unloaded a clip of bullets somewhere. We don't know where it went. So crime's not bad, but you have to understand what you're getting yourself into. I'm not recommending anyone go out and buy a D-class property where nobody's working and there's just disasters everywhere. But you got to understand, in the multifamily space, crime is something that happens. It just, you know, there's break-ins, you know, there's ways to address all of that. So as long as you understand what you're getting yourself into, it's not the end of the world. We have a property up in Columbus, Ohio, very similar. It was 100% vacant. I have videos walking through it. There's, you know, needles and spoons all over the floor. Now we bought it, we secured it, boarded it up, cleaned it out, you know, and it's not in that bad of an area. It's just been a vacant property. So crime's not bad. You just got to understand what kind of crime. Now there are parts of, you know, towns that we will just not invest in because crime is just too, you know, there's just no way it's going to get cleaned up. There's just too much that has to happen, and there's no catalyst that's going to start that unless you just buy everything and start from scratch. But crime is not, you just got to understand the crime and understand the insurance side of what that crime's going to cost. But that last list, and we'll send this out to everybody, if there's one thing, if you leave here tonight understanding markets, there's two things that you want to know: supply and demand and job growth. That's it. That's the whole night. You guys can get up and walk out now, and you've accomplished your time here. Supply and demand is the #1 factor in multifamily, market selection. If you have an inordinate amount of building and no demand for it, obviously there's going to be high vacancy. Tenants aren't going to want to, you're going to have to give them an incentive to live there. So you want to understand how many units are being delivered and how many units are being absorbed. And that also ties into job growth. Typically where there's a lot of jobs coming in, there's a lot of building. So you want a good relationship between how many jobs are coming in, how much building's being done, because where jobs are, people will come and they'll live in apartments. So those two things are the most important when you're picking a market. And then the other one that no one talks about is when you're picking a market, it could have the best metrics on supply and demand, it could have the best job growth in the country. If you hate going there, don't buy it, because there's no return that will warrant going to a place that you absolutely despise traveling to. I know, because we have two deals that every time I have to travel, I hate it. But we knew that going in, and we knew they were short term, so we were okay with it. And I just had a daughter, so I blame that as the excuse if I don't go there anymore. But we have Chris and my partner who does the travel. They do the traveling now, so I throw them on the bad trips. I get to go to the Charlestons and then the fun ones. But you regardless of metrics, it's important to want to go see your properties, but supply and demand and job growth, 100% the number one thing to look for in any market you look at.
So I'm just gonna turn the lights off so everyone can see it real quick, and then I'll flip them back on, just because I figured we couldn't see it. So this is for population growth and population numbers. If you go to, like I said, we'll send this all out with the links, but it's factfinder.census.gov. You can kind of go by the metropolitan areas. They'll give you the actual census numbers for 2010, and then they'll give you the population estimates. So you can kind of take this, throw it in Excel, do a couple formulas, see how stuff is growing, not growing, and kind of get it that way. The second one is BLS.gov, Bureau of Labor Statistics. This is where we get our job growth. So the typical one is total non-farm. That's usually the ones we care about. So that's every other job besides farming. And then you also get employment, unemployment rate, and they have data going back, I forget how far, but I think it's, I think it's into the 90s, but I forget.
It's enough.
It's more than enough to realize what's been going on recently. So you can get a ton of information. I think this is in the thousands, but you can click the Excel sheet, you can download it, and you can have it for your records and stuff to look at. The next one is bestplaces.net. It'll give you some of this information as well. I just, like unemployment, I choose to go to BLS. It's easy just to verify, make sure they don't have it messed up. Job market increase, some other nice statistics, but the one I get from here is the job diversification. So you can see this here. This column is the market. So this is Jacksonville, Florida. I did all Jacksonville, just apples to apples. And this is against the country. So you can kind of see, there's not a large percentage of one type of job kind of there. So it's relying on a bunch of different industries, which is something we want to see. You can also see, median income for the big area, unemployment, stuff like that. So this has a lot of other stuff, we're not even talking about. The next two are crime. Why is this so zoomed in? Don't.
Chris, I have two questions.
Yes.
How old will you accept data-wise in terms of some of those statistics? Bureau of Labor Statistics, that seemed pretty recent, but I forget one of the other ones was like the census, the population growth. That went to 2017, so now we're a year and a half out.
Yes.
How old would you?
Yeah, I mean, you can only get what they'll give you. I think they just came out with state for 2018, so I'm sure they'll be coming out with metros for 2018 too. I would just, if you want to back into it, take the average for the past 5 years and add it to it, and you'll probably be pretty close.
Kind of.
Yeah, you want to see the trend, you want a general idea.
And then,
they're all different tools you're going to use. So.
Okay. And then the job diversification. So what are you doing? Comparing it to national? Do you want to see?
No, we just want to make sure that there's, we don't want to see, the
90%
steel
one?
industry is 25% or 30% or something like that. It's not even not see it, it's just understanding what it is,
Okay.
right? And if it's, there's a lot of different boxes we'll look at and saying, okay, if there's a lot of boxes, maybe we want a higher reward. Or if there's too many boxes, we say, it's not for us. So it's not necessarily that one thing is a deal killer.
Okay.
It's just kind of,
Risk
a bunch of different things and just understanding and then making a decision based off what we're looking for.
The data is out there to assess risk, more importantly than anything else. Is we own a property in Jackson, Mississippi. It's almost an insolvent government. There's nothing good in Jackson, Mississippi. What we bought the property for, it'd be very difficult for it not to work. So it's just understanding what you're getting yourself involved with. That's what all the data is for, to make an assessment. Out of the box, you can make these as strict as possible. Let's say I will not invest in a market that has any one industry 15% or larger. You can do that. There's nothing wrong with that. And you can start. There's 350 MSAs in the country. You'll whittle down to 3, right? And that could be the 3 markets you love. But all this information is to assess, not necessarily, it's not gospel. It's not, hard-coded fact or an algorithm that just spits out the magic market. It doesn't typically work that way. You just want to know what you're getting yourself involved with.
And you can go the opposite direction too, right? If you love military rentals, find the ones that have the highest percentage. Go the opposite way and say, look, I don't think it's going to be an issue. I want to rent to them because I think they're great tenants. find the markets that have the higher percent, right? So it's all about using the tools and just accomplishing whatever you want. So that's it. This is Trulia, has a pretty decent crime map of stuff. I wouldn't rely on it too heavily, but I would, use it against other things. You can see, I don't know why the graph isn't showing up, but the dark blue is high crime, the rest of the light blue is low crime. So you can kind of get a feel for where, especially if you're looking at a new market, get a feel for where a lot of the heavy crime is, and maybe that's an area you want to stay away from, right? So if you're in, if we just, zoom in, right, and this is kind of the downtown Jacksonville area, we know, okay, if you're not in, these areas, right, there's a lot of crime over here. So I might want to avoid these areas, or I might want to learn more about these areas so I can avoid them. Or I might want to learn more about these because they look like great places to be. I know that like this Riverside and this Brooklyn area is amazing, and we know, once you kind of get north of Beaver Street, it starts to get really rough, also on the east side of downtown. So it's not 100%. There's areas in here where it's lighter than I know it really is, and places I would still avoid, but it's just a good tool, again, to kind of do it. There's also another one called crimemapping.com. It doesn't work in all markets, so you have to check. I just know Jacksonville's one where they do use it, and what you can do is come over to here, the when, you can choose how long you want it to be, and it'll show you all the different crimes in a block by block kind of area. Sometimes they're a little off, but they're usually pretty close, and show you what type of stuff there was. So you can see like this was a felony domestic battery. You can see like this is grand theft between 300 and 5,000. Grand theft less than $300. So you can kind of get a feel for, if there's a lot of things popping up, okay, maybe you avoid it. Maybe it's near some retail, so it's different. But like this, I know this Brooklyn area, very, very popular, a lot of new development going on. Probably not going to find any place in, in inner city where there's not any, sort of crime going on. So again, just another tool of stuff to look at.
The other thing is when you're in a market, if you're falling in love with something, you could always go down to the local precinct or call them up and ask them, what's going on. Chris and I toured a property up in Columbus, Ohio, where the owner literally called the FBI on himself to rid the property of crime. So it's all relative, but when you go into a property, you can see if there's a police car there, it could be a courtesy officer. There could be multiple reasons why they're there, but the local people in any market will give you the most insight, whether it's the local police department, the local whatever, maybe that will give more intel to any of this. This data is only as good as the people that put it in, so you got to take it with a grain of salt. But it is important to look at because the deal might look great, check off every box, but there's a ridiculous amount of crime going on in the area. Might not want to be there.
So you can kind of try to look where different clusters are, and if you really don't want crime, maybe you go in this area. If you're okay with it, find someone with different lesson. You can see what type of is too. So again, just another tool. Anything else? I don't know why it went black. There's another slide. There we go. All right, and the last one, is how local can you get. Especially for us, the first one, we'll get a lot of demographic reports for individual properties. We just ask brokers to kind of pull them for that. So they're a little bit more, what's the word I'm looking for, high level, a little bit more in depth than you might get for some smaller stuff. Oh, thank you. And some other brokers. But you can try to get demographic reports, especially if you're talking with brokers or agents. They may have resources you don't have where we'll typically do a 1, 3, and 5 mile radius. So we'll look at what the median income is. We'll look at the different stuff like that. And I have an example I'll show you guys. So especially when we're pushing rents and stuff like that, and we want to make sure that the median income supports the rent we're trying to push to on the requirements we have. So we typically require 3 times rent on an annual basis. So making sure that our projected rent is at or under, typically want to be under what the median income is. So stuff like that. And then another resource I want to show you guys that you guys should all definitely go check out, especially if you really want to get hyper localized, is city-data.com. They have a ton of neighborhood by neighborhood, street by street information on median income, age, population, I mean, the whole nines, and I'll show you, I could spend an hour going through it, but it'll show you, by color, where the high areas, so like let's say you did median income, it'll show you, the dark colors are where median income is really high, light colors are where it's low. Then they also have a really cool feature that you can change from, and it'll show the percent growth from the year 2000. So you can see the areas that grew the most over that time period on a local basis. So you may be looking at an area that is, the highest median income, but it's been pretty much stagnant for the past 10, 15 years. So you may want to target an area that's middle of the road, but has had a large amount of growth the last couple of years, and you think there's a good chance it can continue. So it might just be something you're looking for. So just another tool to kind of look at, and I'll show it to you now. Somebody mind just flipping the light again?
Another good resource, and I think it was a Harvard study, talked about like Yelp and websites like that show good trending up and coming neighborhoods, because trendy hipster type reviews in not so good areas, there'll be good reviews on, you'll see a wine bar, a trendy restaurant. So it was a Harvard article that actually Yelp was way ahead of the curve when it came to like market growth and stuff like that. Do we use it? No. Is it something that you can throw out there when you're looking at markets? Of course you can. But it's something that most people probably don't talk about. But it was something that was years ahead of the curve on like Bushwick, Brooklyn, or Bed-Stuy, Brooklyn, where 20 years ago you wouldn't be caught dead there, right? That's probably the only way you would have been caught there. But now, totally different. So, something like that, completely unique, completely different. If you want to get super hyper local and you're in an area where you think is growing, not a bad idea to check out what's going on from the retail side.
Yeah. So this is an example of the 1, 3, and 5 mile radius report that we got from a deal we were looking at. So you can see it breaks down, population, every column, 1, 3, and 5 miles, so you can get a decent idea of what the population is, how close, how it's grown over the years. You can see how many households there are, right? How many people are in the area, the average size of the family, the number of units, which is hugely important, right? We were talking about supply and demand, knowing if it's staying the same, up, down, sideways, what percentage of the units you are, especially if you're buying multifamily, stuff like that. You can see household income, are you in a good pocket, a bad pocket, how do you match up against the market average. They also project up to 2023 where they think it is. The age per cap, there's 7 pages, I could go through them all, but you guys get a good idea. So it gives you a lot of stuff that you can look at, and again, there's some things you're really hyper focused on and things you want to know, right? If you are student housing, you really want to focus on the 18 to 21 year old demographic, right? You may want to look for places that have high percentage of people in that region or something like that. So there's that. The other one that I mentioned is city-data.com. So what we can do, I'll just type in Westbury, New York. All right, so we can just kind of see the area we're in. You see it'll give you a couple breakdowns of some stuff. Honestly, that's not why I use this. This map is why I use this right here. And what you can see, I apologize. So right now, it's a little small, so it's kind of annoying. Can zoom in? No, it's just doing the map. It's a little tough, but you guys should go play around, right? The red outline is Westbury, but these are all the surrounding towns. Right now it's doing median household income, right? The dark purple is, the really high income areas, and the light is the low income areas. So you can kind of see stuff like that. And what I was talking about is there's this button right here, percent change since 2000. What you can do is you can click that and you can see the areas that have really grown, right? So you can see some of the parts of Brooklyn and Queens, right, that have really come up since then. You can see areas like, Garden City, this is probably Hempstead, but you can see there's the area right there just north of Westbury, right, that hasn't grown, right, in this pocket. right, south Oyster Bay, north Westbury, hasn't really grown much, so it might be something you can consider. So it's a really cool tool like that. You can get super, localized. You can do things by household income, race, unemployment, population. There's a ton of stuff you can look at. House or condo value. Maybe you want to see something, if you want to hold a bunch of stuff for 20 years, could be interesting to see how it's changed. So it's just, again, another really good tool. Oh, there's more, yeah. I was going to say, I thought there was crime. Yeah, there's crime. It's good to look at, poverty status, number of occupied and vacant housing units, right? If there's a large number of vacant units, or it's a neighborhood that's had an increase in vacant units, maybe something you want to avoid, or maybe you see it as an opportunity. School enrollment, again, I could spend a whole day going through this stuff, showing how stuff works, but definitely something you guys should all check out. Just play around with, get familiar with. Really interesting. It's really easy to remember. city-data.com. You just type in the one and it kind of just pops up. But yeah, those are 2 ways you can kind of really get locally focused. That's pretty much it for me. I don't know.
Yeah,
You've got anything else?
that's the quick version, obviously. We didn't want to be up here just lecturing you guys on everything, right? We wanted to be more open forum. This is the high level. Hopefully you got some good tips and that you guys can use on anything you're looking at. But is there anything here that we spoke about that anyone wants to address a little bit more? If there's any more questions, or anyone have any more particular questions to markets or something like that? Tom?
I'll use areadevelopment.com.
Great website. That's a website that it'll show like things going on, where there's targeted jobs or where jobs are moving to. It's a very good website. It has a lot of good data.
Did you say before that we could get these links?
Yeah, so I guess I'll do it now. For anybody that's coming late, there's a sign-up sheet in the back. You don't put your email down, you're not getting it. So if you do, put your email down, or you'll get an email within a couple of days with it.
So I should have played. I don't know if you guys mentioned, what is the household income that you are looking for?
Depends. It depends on market in particular. There's nothing, we don't want, we have properties where we're below the national average, and we have other properties that are well above. That's not a box that we typically check off, for the most part. It depends on the deal that we're looking to accomplish, because a lot of the deals we've been buying over the last 5 years have been, more heavy lifting, rougher deals.
Yep.
So it'd be significantly lower. Where we own some deals. One of the worst performing deals we bought was in the highest average income area. It's the nicest property we own except for our new construction deal. We had to evict 56 tenants out of 240 the day we bought the property, because it was just filled with the worst tenants, running a whorehouse out of the leasing office. And then decide if you like it or not. But that's what I would just recommend. Google, top 10 real estate markets. Zillow does a great report every year. All of the websites produce something that'll show, these markets are growing, these markets are shrinking, these are where people want to be. Top 10 states where people are moving to. Something like that. Top 10 anything blank real estate, you'll find some markets that you'll probably have an interest in.
Have you ever bought a property without putting eyes on it yourself?
No, never. We won't do that. We
I know
will buy
some
a
people
property.
do like real estate, agents will go do walkthroughs on video, doing like a FaceTime or whatever, and literally go through the entire property over screen.
Yeah, no, we've done that,
Yeah.
but we will not buy a property unless we've walked every single apartment, whether it's myself, Chris, my partner. We have a 453 unit. Did I walk 453 units? No. Did someone from our side walk every single unit? Yes. We walk every single unit. We read every single lease. We tour every single deal more than once before we buy it. That's us. I'm not saying it's the way to do it, but it's definitely something that we do.
And just on that, that's not every deal we're thinking about buying. It's
Correct.
Walking every unit is when we have a deal under contract. We'll also have somebody go through several of the units and walk the property before we put it under contract. Not always one of us two, but someone from our management company or if we're in the area. It makes it really easy when you own in the area. You go down, you check out some of your own properties, you check out some ones you want to buy, you walk 5, 10, 15 units, you walk the rest of the property, you go see it. But once it's under contract, before we go hard on any deposits and before we actually purchase it, we walk every unit and have vendors inspect it and stuff like that.
Yeah, we'll offer on deals without looking at them frequently.
Yeah,
because
well,
you just can't, but we
understood.
won't close on them.
Yeah, understood.
AR-15. Almost shot his friend that he was with. He literally like pulls the gun and just starts shooting into the, I don't know where. But would we buy a property with a murder? Maybe. It just depends on what's going on. If it was an isolated incident, if it was 7 murders, probably not. One here and there is not a problem. No, it's it just depends on the situation. If it's an area that's growing, some things happen. You got to understand that, but it's gonna come with an insurance cost too, because it's gonna come back to you one way or the other. Be aware of what happened. I wouldn't just rule it out. Just understand why, and if it's something that's going away or continuing. We also had a property we just sold in April that. There was a targeted killing for, what was it? The person was,
Gang member, right?
no, it was, he was one of 3 witnesses left in witness protection program. That was for a huge drug smuggling thing. It was in Charleston, great area, and they killed him. Pretty badly. But it was a targeted killing on witness protection. So that was one of our properties, and we sold it. So it happens.
Before or after the killing, you sold it?
After, actually, not too like a couple of weeks after the killing. It happened. It just, it's a multifamily. That's a strange situation.
Yeah, that's
But
unusual. Yeah.
when I was a broker at Marcus and Millichat, we listed a 8-family in Bed-Stuy. The day we got the listing, we went home. The next morning, there was a murder on the corner. It was a corner property. Literally taped off with like the marking on the ground. So we called the owner and we're like, might have to hold off on listing this one because it may hurt. It depends. It's not the end of the world, but I'm not saying to go out and target murders and go buy those properties. It's typically not a good strategy, but it just you want to understand what happened. And we also had we walked on a deal in Montgomery. We lost money on it. We lost our deposit because there was 2 units that literally targeted shooting. And I said, you know what, I'd rather lose the deposit than buy the property because I'm not going to get involved in that situation. So, know when to cut your losses also.
So basically you work on rentals, revitalize them, and turn them around? Is that
Correct.
what you-
Yes, our business plan, at least for the last 5 years, has been buying properties that are a little bit rougher that need some love. We'll come in, we'll fix all the problems, and maybe we'll do interior upgrades, depending on, what the business plan is. We've always said 3 to 5 years. We've typically sold in 24 months to 4 years. Going forward, we're definitely targeting 5 to 10 year olds. Just, we don't know where we're at in the market. I think we still got some runway, but the business plan hasn't changed. We're still opportunistic. If there's a time to sell, maybe a little premature, we'll take it. But yes, we're going in, fixing the problems, getting it going in the right direction, and then we'll pass it off to the
What's
next
your target return?
So the returns vary based on deal, but we're typically targeting anywhere between a 12 and 18% IRR to the investor.
For the full
Yeah,
holding
for
period?
yep,
What did you say? I'm sorry.
12 to 18%.
12 to 18? Okay.
Before, when you were talking about goals, you said that if you didn't have a lot of capital, you'd focus more on wholesaling and flipping, and then if you did have a lot of capital, you'd focus more on stable markets and renting. Why?
Didn't say you could. I said a lot of people do.
Like, why?
Right? You see all the time, right? How to get involved in real estate quickly with no money.
Yeah.
They're usually selling a wholesaling or a flipping course. So it's just a very easy way. I mean, the way we do it is we make money from other places and then we put it into rentals. So, if you can have something else that brings money into, it's just, you need money to buy rentals and stuff like that. So it's a little bit tougher, but not impossible. We don't have, me and him don't have, $20 million to buy all the properties. We have, we include investors, so we're able to scale up that way. So that's another way of doing it. If you don't have the capital, it's go find someone or some people that do. Tell them what you want to do. So, say I'll put in X. I'll do all the work. You just sit back and here's what I want to do and here's my plan. And if you have any sort of track record or whatnot, go and do that. There's plenty of people that are willing to partner. And if you have less of a track record, give them more of the upside, right? Give them more ownership just to get your foot in the door. So, it's all about finding a structure that you can make it work, even if you don't have money. So it's just more. I said that because more people tend to go that route than they don't.
Are you guys refinancing out of these properties after you rehab them?
Sometimes. It just depends. Here, the truth of being a sponsor or on our side of the coin, it's not necessarily the most advantageous thing to refinance a property because we get paid on performance. we invest 10 to 20 to 50% of the deal. So yes, our money makes money, but we make the bulk of the kicker on performance and selling. You know, we're not heavy fee based. We don't have, you know, a ton of refinance, you know, a refinance fee, a disposition fee. It's based on performance. So the answer is, it's not necessarily the most advantageous thing from a sponsor standpoint. From an investor standpoint, you know, we'll look at the option. If it's the best move for the investor, you know, we'll have a discussion, see if we could move something around. We do have one deal that the plan is to refinance it and hold it for 10 years. It's a vacant property we bought in Columbus. The plan is not to sell it, but the sponsor fees were a little bit more aggressive than a normal deal to incentivize us to stay in the deal.
So do you normally finance or you buy outright?
So we've done both ways. We've bought deals all cash and then refinanced it. Just, you know, aggressive purchase. You know, hey, we'll buy it for all cash. We'll close in 30 days to get a good price. We would buy it with our own money and then syndicate it out, like the deal we have in Jacksonville. We bought it with our own cash and then we raised money from investors. We've also just gone right down the financing path right out of the box. So, you know, we're going to put 20, 25% down or 30% down, and then finance the rest with a, you know, a traditional bank.
Finance companies you work with?
Yep. Yeah, we've done, you know, everything from, you know, bridge loans to, you know, stable 10-year agency debt, you know, Fannie and Freddie Mac, just super, you know, clean deals.
In a brand new market, how do you find your lawyers?
So our lawyer is all based here in Melville.
So whatever state, doesn't matter.
He uses local counsel that they've worked with in other markets. So, you know, we have CPA being transitioned out of quickly. Our CPAs we use are here, and our lawyers are here. They're in Melville. They handle all our transactions from the business side to the real estate side. They do the whole 9 yards.
Let's say you do everything right and find a nice market, you hold the property for a little while. What are indicators that, you know, it might be time to get out of the market once you kind of have the property?
That's a good question. Recent trades is always something that we look at. You know, if people are buying things at ridiculously low cap rates, you know, we may want to take advantage of a sale. You know, we're buying a lot of deals in Jacksonville right now. We're also selling one of our deals in Jacksonville because the trades have just been crazy. We've executed our business plan with a lot of excess cash in the bank. So we have 6 years left on the loan, or 5.5 years left on the loan. We can hold that deal, and it may turn out to be good. But the offers that were being thrown out there, there's no, you know, we're going to take a profit and move on. Other indicators, you know, look at the vacancy, look at supply and demand. If you see vacancy start ticking up, you may want to think about selling. It also depends on your debt position. If you're going to cover your debt and you're cash flowing, and that goes back to the goals. If you're hitting your goals on cash flow, you may just want to hold it and go through the cycle, right? You want to, you know, factor some stuff in, but I would say vacancy ticking up, unemployment ticking up, you know, maybe job growth going the opposite direction. Just like we look at that stuff to pick a market to buy, we may look at that stuff and say, hey, it may be time to sell. I think most markets are at the tail end of the cycle, but that doesn't mean you can't make money and buy deals during that time frame. You just got to buy them right. And if you buy something right, regardless of the market, you should be able to be okay. If you overpay at the tail end of the market, it may hurt a little bit.
Do you look at the cap rates?
Cap rates not so much from our standpoint, because, you know, we're buying a lot. You know, we bought a vacant deal. There's no cap rate on it, so it's not as important. Looking to sell, you know, it's only as good as the information that went in. So the cap rates are subjective, right? You know, we sell deals, we say it's a 4 cap, but what's included there. So you want to understand historicals and what normally goes on in that market, but cap rate isn't as much, you know, as important as maybe, you know, price per door and average rent. You know, if the average rent at this property and the price per door is X, you should be able to be similar.
What's price per door?
Like how much you paid per unit.
Okay.
So if it's a 100-unit property and you paid $5 million divided by 100, and your average rent's $700, and the neighbor's property or the property of the block is very similar, same year, same everything, that may be a little bit of a better indicator than a cap rate, because, you know, financials are, you know, 50-50. I think someone had a question over here now.
I had
John,
a multifaceted question. For one, is the properties that you guys are looking at as of right now, are they mostly multifamily? Is it that's it? It's like all like 400 unit or whatever they are that you're getting looked at. The second part of it is, if those investors that you are getting in on properties, do you have like investors that you go to each time you have that property, or is it just every investor's involved in each property, or is it, how do you guys?
Yeah, so yeah, all the deals we're looking at right now are all multifamily or mobile home parks. Typically, our investors, current investors, will get a first look just out of pure respect to them.
Fair enough.
They'll get it sent first. Sometimes capital, maybe they're a little, restricted on capital, or they don't have it right now. So they may say, yeah, not this one, the next one. Then we'll send it out to everybody else. Once everybody gets it, it's basically, if you say you're going to invest, you move up. If a written commitment, you move up, and then money in the bank, you're in the deal.
Gotcha.
We'll give everyone a fair amount of time before we say, hey, it's put up or shut up.
Okay, so then my third part of the question is, once you do put that money in, is it literally based off percentage of what you're putting in based on that deal? So, you have $300,000 deal and you put in $30,000, you get 10% of that deal. Is it 10%? Are those properties that you're flipping? They're technically flips, right? In a sense.
You could call
it that. So if you're rehabbing those properties, let's say all 400 units you're walking through, are those units ever getting rented under your ownership, or is it literally just rehabbing them and putting that back on the market in a 2-year span?
No, so when we do the work there, they'll get rented up.
They'll get rented.
Yeah, they'll get rented by the market. But the way that it works in our deals, the easiest way is if $1 million investment you put in $100,000, you're a 10% owner.
Gotcha.
So you own 10% of that property, and the money comes out of the property into your bucket, imaginary bucket, and that gets split with us based on performance.
Based off your performance.
Exactly.
Understood. And once you do that, if they are rented, are you getting as an investor, are you getting percentage of that rent that is coming?
So the property will bring in,
the
property will bring in its income for the month. You'll pay the expenses, whatever the net income is, you'll pay your debt.
And you get that 10%.
And then you'll get your percentage of that.
Okay.
John?
Oh, so I know you're in an opportunity zone right now. You purchased one recently, right? Are you targeting opportunity zones right now? And have you ever utilized an opportunity fund for financing?
Not targeting opportunity zones. Sort of just stepped in it on that one. It was actually Mike Anspach who said, he's like, you should look if it's in an opportunity zone. It happened to be in an opportunity zone. We did look at some here and there. We own another property that is in an opportunity zone that we may develop to phase 2 because of it's in an opportunity zone. So yes, we don't target it. It's a nice benefit, but it's all relative because you got to put in more money than you paid for it. So you're not going to be able to buy a multifamily property that's occupied most likely and get any benefit of the opportunity zone, because you're gonna, if you buy it for $100 a door, if you buy it for $60 a door, you're gonna have to put in $60 a door. That's a lot of money to put into it. So we're not targeting it. If it checks off the boxes, yes, we would throw it out to people, but not a target. And we've never used an opportunity fund for money.
So it's more of a tremendous value add or development deal that would
Correct.
fit? Okay.
There's some other things too, but for the most part, yes.
It also got really hot really quick.
Yeah.
And a lot of focus on it, so it's tough, right?
Right.
Targeted towards really distressed buying people or developers, so not a space we're necessarily heavily in and heavily focused, and to kind of shift and then compete with everybody, decide not to basically.
Yeah.
Can you just explain what an opportunity zone is for those who might not know?
An opportunity zone is basically a new tax code that was written for the next 8 years that allows you to use capital gains as an investment without paying capital gains tax today. You have to pay them in the future, but then in 10 years, your basis of your property, so what you bought it for, gets stepped up to fair market value. So your capital gains, which you pay in 8 years, goes away when you sell it. So you wouldn't have to 1031. You shouldn't have to 1031, depending on if the tax law changes in 8 years. But it basically allows you to invest gains from something, whether it's the sale of stock, the sale of a business, the sale of real estate, without having to do a 1031 or without having to pay taxes today. You defer them for the future.
Anything else?
So as a newbie, I find a market, and I know there's a lot of ways you can find a property. You can drive for dollars, direct mail, but as a newbie, do you think Zillow or any of those websites have opportunities, or what would be the best way?
Depends where you're looking. I personally struggled to find anything on Long Island through MLS, Zillow, or anything like that. Not saying you can't, just when I tried, had zero success. In other markets, I can't really say. You'll obviously have a greater chance of success off there than you will on, because it's very easy to go on Zillow and look, right? There's tons of competition, right? The less competition you have, way more likely you are to find a deal that works. So it's great practice, especially if you're a newbie, right? To say, hey, let me try this house, let me analyze it, see if it works. If it doesn't work, why didn't it work? If it does work, try to do it or find a partner or whatever. So worst case scenario, you're just, you know, doing more, getting more repetition, getting better at it, making it quicker. But I would say you're way less likely to find it on there than driving for dollars, direct mail, cold calling, the whole nine stuff.
Now that's all relative to what your return expectations are.
True, that's a good point too.
So if you're looking for 6% on your money, you can probably buy any deal on Zillow. But it just depends on what you're looking to accomplish. So, you know, there are some people that are very happy with buying a single family house and making, you know, 5-6%. It can work. So that goes back to the goal setting. If you want to make 20-30%, probably be a little bit more difficult. So, but it's not a bad way to practice. Start, you know, when I started, you know, the fear of getting started is not knowing what's going to happen. But if you see a deal on Zillow or you see a deal while you're driving around, you could always write the address down, and in 3 months, if you drive by it and you see it's completely renovated and back on the market, you can go through the public record, you can go through websites, and you can see, oh, what was it bought for? This is what they're selling it for. Go to the open house, ask questions. You can teach yourself by doing that and then learning, okay, this is what they did, I have to do this. So it's a good tool to practice, and then depend on expectations and what you're looking for. It could be a great tool.
All right. Nobody else? All right. Awesome. Thanks, guys. You know, we'll be around. You know, we've got the room for a while. This was way quicker than we're used to. So feel free. Water and coffee in the back. Bathrooms are by the stairs when you come down. And that's it. Feel free to get to know everyone. If we haven't met you yet, please come say hello. Thanks for coming.